Hey everybody, Dr. Phil here. This is going to be a video on confirmatory business analytics, particularly looking at predictive and prescriptive analytics. All right, so let's jump right into it. The first thing I want to talk about is in this video is deterministic versus probabilistic analysis. Some big words there. Now, whereas descriptive and diagnostic data analysis are more deterministic, generally reporting known facts, predictive and prescriptive analytics provide less deterministic output and more probabilistic models, judging the likelihood and probability of a future event or outcome occurring. With deterministic models, all events are known beforehand. With probabilistic, there's always an element of chance, think about the term probability, of whether or not it will happen. Confirmatory data analytics are predictive and prescriptive data analytics that use various techniques and statistics to evaluate the likelihood or probability of a future event or outcome occurring. Now, while exploratory analytics generate deterministic output, confirmatory data analytics provides less deterministic output and more probabilistic models, judging the likelihood of a future event or outcome occurring. Predictive analytics addresses the question of whether something or some event will happen in the future. To the extent that there is a strong correlation between the past and future, predictive analytics can be particularly useful. Predictive analytics provides foresight by identifying patterns in historical data by assessing likelihood or probability. So here's some examples of the use of predictive analytics. So the first one is predicting which customers will be able to pay back their loan. This might help decide whether to extend credit to potential borrowers. Number two, predicting Google Pixel demand over the next calendar year using, past or previous demand. Number three, identifying various customer segments at Best Buy. And number four, predicting future performance, including sales, net income, and cash flows. So here we see some techniques. So classification, we would separate or classify a sample or a population, more likely a sample, into two or more groups or classes. Regression predicts a specific outcome value based on independent variable inputs. And a time series analysis predicts future values based on past values of the same variable. So here we're talking about separating into groups or classes. So there's different ways to do that. What are some ways that we might accomplish that? Well, identifying and marketing to customer segments. Extend loan, do not extend loan. Identify fraud, no fraud use of credit card. And then here we see customer segmentation by touch points. So classification into customer segments can be done based on any, and this isn't an exhaustive list, obviously. These are just some examples of touch points. So number one, communication touch points. So like websites, email, snail mail, just like regular mail, SMS messaging, etc. Number two, human touch points, interaction with a salesperson or customer service rep. Number three, physical touch points, physical store location, product and packaging. And number four, sensory touch points. So things like fragrances, store lighting, store design could be some examples. And here we see customer segmentation by purchase patterns. So here we're looking to classify customer segments based on the evaluation of purchase patterns. So number one could be like level of sales, customers who bought the most stuff. Number two, types of purchases. What customers purchased, like what did they buy? And here we see classification with respect to offering a loan. Which customers will pay back the loan? So banks and other lenders evaluate borrowers based on their creditworthiness to decide whether they will extend a loan to them, obviously. Lenders use various borrower characteristics for individuals, including credit scores, work history, existing levels of total debt, debt to income ratios, if they own or rent their home, as well as other factors to determine whether to extend a loan. And predictive analytics technique, one of which is regression. So regression is a predictive analytics technique that allows the analyst to predict a specific dependent variable outcome value based on independent variable inputs. So the question basically is, are the independent variables associated with the dependent variables? So an example could be if the dependent variable is cost of gas, cost of gasoline, what are some things that affect that? And those would be the independent variables. So as an example, a cost example, firm cost behavior. So how are firm costs dependent on the level of production for a company that makes composite decking? So the dependent variable, we would abbreviate DV, is the total production costs. The independent variable, which we abbreviate which we abbreviate IV, would be the board fee produced. Another example would be interest rates and social media sentiment examples. So what interest rate do we give to a borrower? The dependent variable would be, of course, the interest rate given to the borrower. The independent variables, these would just be, there'll be a lot more than this, obviously, could be thousands, but some we might choose to study could be borrower income, the level of debt compared to income, credit history, rent versus own, and credit score. And then time series. So one of the most important things accountants do is forecast future sales, earnings, and other measures of performance. So time series analysis is a tool or technique used to predict future values based on past values of the same variable. One of the reasons accountants carefully measure the past is to be able to predict the future. Now, base rates are defined as the probability of an event occurring based on a related historical average. So the problem with this is what we call base rate fallacy. And this occurs when the prediction places too little weight on the base rates of the past and instead uses different or potentially new information. So let's take a look at an example. So let's imagine our statistical model predicts rain 3% of the days this summer in northwest Arkansas due to El Nino. But the base rate in northwest Arkansas is that it rains 15% of the time. So how would that affect our analytics? Now we define prescriptive analytics, as analysis performed which identifies the best possible options given constraints or changing conditions. So what type of constraints might a company face? Well, firms don't receive unlimited capital resources, right? One thing you learn in economics is this idea of like limited resources. So they must optimize their resources based on what they have available. So what type of changing conditions might a company face? So a lot of things, right? Consumer preferences, tax laws, interest rates, risk levels, exchange rates, demand for employees and their expertise, and a lot more. Now, with respect to predictive versus prescriptive analytics, while both of these forecast future outcomes, prescriptive analytics goes a step further and helps to make specific recommendations for management to consider based on what they expect will happen. So some examples of prescriptive analytics. So, and we'll talk about these a little more shortly. So a what if analysis, including marginal analysis. We could also run what's called a cash flow analysis, a scenario analysis, a goal seek analysis, and a sensitivity analysis. The ones I'll focus on here is probably what if, really what if analysis. So what if or marginal analysis. So what if analysis is a prescriptive analytics technique that evaluates how potential changes in inputs may affect outputs. Marginal analysis is an examination of the associated cost or benefit of very specific business decisions. Marginal analysis typically refers to the cost or benefit of the next or the marginal unit. Now, marginal analysis can be applied using financial modeling, which is a representation or model of the financial outcomes resulting from a decision or future events. So let's look at an example of this type of analysis. So let's say the manufacturer decision is, should the manufacturer expand their operations by adding new product lines or increasing the volume of what they currently produce? Audi is trying to decide whether to manufacture more of their current lineup of cars with gasoline engines or invest more in electric cars. They will use marginal analysis to help decide the financial and other implications of their decision. Let's look at cash flow analysis. So this type of analysis, cash flow analysis, is a prescriptive analytics technique that evaluates future cash flows for potential investment or potential expenditures. This technique is frequently used in accounting and finance, and will be explained in other videos. So what if scenario analysis? So what if scenario analysis is the process of analyzing future events by considering potential outcomes. Scenario analysis does not try to predict one possible outcome, but rather it presents a range of alternative outcomes. While it considers a range of outcomes, it also computes the expected overall impact on the company based on the joint probability of multiple events on the company. All right, as always, thank you for watching, and I will see you all in very soon in a future video. Thank you.